A very happy evening to everybody who was assembled here. In today's session, we are addressing specifically for those who are preparing. In today's session, we are addressing specifically for those who are preparing. For those who are preparing for your examination in the month of June 2024. Now we'll be looking at the type of questions that could be coming in by taking as an example of the previous examination, that is from December 2023. So what we have observed, the first time in the entire syllabus or the curriculum, there is a shift from the old way of looking at the exam to the new way of looking at the exam. Wherein until June 2023, the students were required to answer in an MCQ mode, but from December 2023 onwards, there is a two possible options that are available before the students, that is both under new mode and the old mode. Under new mode, it is subjective based, where no more there is MCQ based questions, but the new syllabus comes up with the subjective based, where you'll have to solve the answers. So with that, now in today's session, we'll be taking up the new syllabus question paper of tax laws and practice from December 2023. So the screen that you are visible or you're able to see on the screen gives the quick summary of the time allowed in the question paper to be answered is 3 hours. The maximum marks that can be gained by answering all the question is 100. And the number of questions that needs to be addressed is 6. But internally, we also enjoy certain options in terms of alternative questions or optional questions that could be available as a choice to be selected by the students, irrespective of the kind of session that or the answers that they need to write. So the question paper is of around 16 pages in December 2023, wherein there were around questions of all sorts of from the tax laws in practice. We look at the bifurcation in terms of how the question paper looks like. So it is overall divided by direct tax, that is the income tax, and the GST law and customs. So the customs and GST law gets 40 marks weightage in part 2, and income tax or the tax law or the direct tax gets the weightage of 60 marks in part 1. So if you see that the questions all the questions has to be answered. So the important note is that all the questions has to be written. All the answers to all the questions has to be addressed. From the perspective of the part 1 and part 2, if we see the part 1 question paper relate to Income Tax Act 1961 and relevant assessment year 23-24, unless stated otherwise. Now, for those who are writing in June 2024, this will change. Assessment year 24-25 will be the relevant assessment year for which the focus of answering would look like. All the references in terms of part 2 is from the GST law and Customs Act 1962. Wherever necessary, suitable assumptions can be made and same be stated clearly in the answer. Working notes should form part of the answer. So this is the overall instructions that are available in the beginning of the question paper. So I could like to see if can I get some response from the audience, those who are watching. Is the screen visible and are you all ready to get into the discussion? Or can I get the response in the chat so that I can take this further? I hope all of you are writing the exams in the new syllabus mode, right? Anybody, can I have a quick yes in the chat box of the live from wherever you're watching? Okay. Okay. I would like to have the feedback from everybody so that we can make it interactive. And if you have any questions or any other challenges as we go ahead, you can put it in the chat box and that can be addressed accordingly. Okay, so let's quickly go into the first question. So first question being the compulsory question and lengthy question. However, it becomes very simple when we see it from the perspective of the what is asked for. So whenever you approach the question, don't jump into the conclusion from the perspective of lengthy question and assuming that it is a complicated question. If I could quickly run through the end part of the question, if you see, there are only 3 sub-questions which have been asked. Sub-question A, sub-question B, and sub-question C. So the first sub-question here says that determine the residential status of Mr. Vijay for assessment year 23-24 along with detailed working. So this is as good as that you have one small sub-problem, sub-concept that needs to be looked into is the residential status provisions. Next comes this next sub-question, compute income from salary of Vijay for assessment year 23-24 on the assumption that he has opted the scheme of section 115 BAC. So here the focus is entirely on the salary provisions and income from salary. And then we go to the sub-question C. It says with reference to loans taken and contribution to political party, compute the amount of tax benefits or deductions available to Mr. Vijay under various provisions of Income Tax Act for assessment year 23-24, so that he gets the maximum benefits, assuming that he does not opt to pay tax under section 115 BAC. Now, if you look at this third thing, it is focused on the chapter 6A deductions. And in terms of ATEEA, ATEEB, and ATG, or the donation political party comes under GGB, GGC. So these are the 4 different sections which are looked into in terms of what is the concern or what is the kind of question that is targeted for. Now that you understand, and it is divided into 3 different segments, and it is made into smaller parts, now you go and read the facts of the case. Now you have already fine-tuned as to how to approach the question. If you keep on reading the facts when you don't know the question, it becomes a kind of tense and a kind of stress or pressure is created, thinking that so many information is given, which one, why, what has to be considered, where to start, what information has to be considered from which perspective, becomes a little dicey thing on an examination environment perspective. For the fact that remains is that all the questions are divided into smaller parts. Be rest assured that it is going to be very simple when it looks from subsegments. In that perspective, when you approach the question paper, it becomes very easy for you to answer. So here in question number 1, we have been asked for residential status as first sub-question, and salary provisions and chapter 6A deductions. So these are the 3 concepts which are dealing with the things. And now when you read the question, you can channelize and focus to think only with these 3 limited perspectives. And I would also like to bring to your notice that the fact pattern in the question paper is very simple and very straightforward. The first set of fact pattern relates to residential status. This middle part of the question with the facts remain with respect to the salary income. The last set of the question remains and connected to the chapter 6A deduction. So it becomes very important to understand the reading of the question, understanding the question, and then process the learning and the kind of revision that you would have done in terms of the implementation. Most of the times we jump into the conclusion in terms of, I know that, I know this, I have read this, I am very ready to write the answer. When you start jumping into the conclusions is where we go into the challenges, and that would result in a kind of an unfavorable situation. Now that we know how to approach the question, we need to understand where are we channelizing and focusing our thought process in terms of the fact pattern. So question number 1 is a lengthy question. However, we now know that we should be focusing only on residential status, salary provisions, and chapter 6A deductions. In chapter 6A deductions, we'll be focusing only on the deduction under interest provisions and deduction under contribution provisions, that is ATEEA, ATEEB, and ATE, read with the ATG, ATGGB, GGC. Only these 4-5 sections of chapter 6A deductions can be tackled upon. Okay, so keeping this in framework, let's quickly proceed to the question. Now, if you see, the first paragraph completely gives only about the residential status. First 4-line items very clearly says, Vijay, an Indian citizen, was living in Delhi since 1972. He left for France on 1st August 2017 and comes back on 2nd April 2022. On the same day, he joined BGH Industries Limited, Delhi, as a chief mechanic. He went to China for 15 days during the year in the month of July 2022. That's all. Till here, the first 4 lines gives the information related to the first question. That is, determine the residential status of Mr. Vijay for assessment year 23-24. Okay. Very simple. Only 4-line question. For the first sub question, you are ready to gaining 5 marks. Okay. Let's finish this part and then proceed to the second part. Let's tackle down this into the solution solving thing. Hope the screen is visible. Can I get a quick confirmation on the answer solving thing that is visible on the screen? Question 1, part A or sub question A. So for this, we will be plotting certain facts that are given in the question. Was living in Delhi since 1972. Since 1972, he is in Delhi. Okay, since 1972, he is in Delhi. He left for France on 1st August 2017. 1st August 2017, he is moving out of India to France. That means from 1st August 2017, he is not in India and comes back on 2nd April 2022. 2nd April 2022, comes back to India, and during FY 22-23, 15 days he is traveled to China, which means he is not present in India, not in India for this period. Okay. What else he has been given during the month of July 2022? That is what they've given. In July 2022, he has gone to China. So immediately we have provisions of section 6, subsection 1, and section 6, subsection 6, which deals with the residential status of an individual. And section 6, subsection 1 gives us the immediate conditions. Okay. And section 6, subsection 6 gives us the, let me quickly. Okay. So if you see here, so this is the guideline answer. I'm just having as an indication here for you to show you how the things are going through. Okay. Now, when we go in terms of calculation, the condition is that there are 2 basic conditions, what you need to evaluate. Now, I'm not going to again recreate the answer, what is given in the suggested or the guideline answer. So I know everybody has access to this. I will give you the perspectives and approaches as to how you need to look at it in terms of the solving. And then we can anyhow get into the format and prescribed in the guideline answer. 2 basic conditions. What are those 2 basic conditions? One is that person and Mr. Vijay should have stayed in India for more than 182 days during FY 21-22, 22-23. Correct. So they've asked, the question is here about assessment year 22-23. Correct. The previous year here that we are solving is 22-23. So Vijay should have stayed in India for more than 182 days. And the second condition is that, is the second condition alternative condition or an inclusive condition? If the first condition is not satisfied, then we can check for the or. It is an or condition. If first condition is not applicable, then we can evaluate if second condition is getting satisfied. Vijay should have stayed in India for more than 60 days during FY 22-23 and more than 365 days during last 4th previous year preceding to the current previous year. So prior to the prior to the 22-23, last 4 years, he should have stayed for more than 365 days. Having said this, if he satisfies these two conditions, then he will be considered as resident in India. Now, what are the additional conditions? Now, can we conclude whether he is there for more than, either he should satisfy condition number 1 or he should satisfy condition number 2. Now, here we need to evaluate if he has stayed in India for more than 182 days, then he is satisfying one of the two conditions. Okay, let me write here one of the two basic conditions to be satisfied. Now, if we see from this perspective, the facts that we collated here, okay, what does this look like? In 22-23, 2nd April. So 1st April 2022 is not there in India. From 2nd April 2022 till 31st March 2023 is in India. Now, if I calculate the number of days, out of 365 days, 1 day is not in India. That means 364 days he is in India. Apart from this, in July, 15 days is not there in India. In July 2022, if I reduce this, 364 minus 15, I get 349 days present in India. Since he's present in India for 349 days, the first condition of basic condition is satisfied, that he has stayed for more than 182 days. The moment that he is satisfied the basic condition, we will check for additional condition. What is the additional condition? The additional condition states that out of last 10 preceding previous years, he should be resident in 2 previous years. And here the condition is dual condition. Both the condition he should satisfy. 2 out of last 7 preceding previous years, he should have stayed for more than 730 days. Now, how do we check this? So what is the current previous year? So the previous year is 22-23. Prior to this, how many days are there? 21-22. 2020-21. 2019-20. 2018-19. 2017-18. 2016-17. 2015, 16, and 2015. So let's keep this here. We'll stop here. Though there is only 8 years, we will get the answer in this. How am I telling this? Since 1972 is in Delhi. 1st August 2017 only he moved out of France. That means 1st August 2000 comes in 1718. That means here in 1718, 1st August, he moved out. That means he is there in India till 1st April till 31st July. That means for how many days he will be there? April 30 days, May 31, June 30 plus July 31. So 122 days he has stayed in 1718. 122 days. 16-17 he is there in India, 365 days. 15-16 he will be there in India, 365 days. He is there in India, 365 days. 18-19 is not in India, so 0 days, nil. 0 days, nil, nil, and nil. So this is the analysis that you get to carry out. Now here, when you see here, In the last 7 years. What are the last 7 years? These are the last 7 years. Now, in this 7 years, he's there for more than 730 days. If you calculate in the last 7 years, 122 plus 365 plus 365, you're having 852. So these are the 3 days. He is there for 852 days. So one of the basic condition is satisfied. Now he should be resident for 2 previous years. Now, if you see for 16-17, he is resident. 17-18, he might not be resident. So here he is not a resident. Okay. Here is non-resident since he has not stayed even a single day. Here he is non-resident. Here he is not non-resident. Here it is he is non-resident. Here he has stayed for 60 days and 365 days in the last previous year. So he will become RNOR in this year. Here is ROR. Here is ROR. And here is ROR. That means he is resident, or basically he is satisfying the 2 basic conditions. So thereby we can tell in the last 10 years, for 2 years he is resident, and in the last 7 years he has stayed for 852 days. So let's quickly see the summary here. If you see, check the first basic condition, stay in India for a minimum period of 182 days or more during the previous year. Mr. Vijay has stayed for 349 days during the previous year, 22-23. So this test is satisfied. So Mr. Vijay is resident in India during the previous year, 22-23. Keeping in view the fact of the given case, Mr. Vijay satisfies the 2 additional conditions also. He is resident in India in 2 out of 10 preceding previous year. If you see here, he is resident in 16-17 and 15-16. In 17-18, he has stayed for 123 days. So that thereby he's getting, why are we getting this 123 days? Here we have taken 122. 1st August he left. So the day of leaving is considered as he has stayed in India. So this will become 123 days. So thereby, how many days that he has stayed? Here, second basic condition or none of if left in India. So you see here, basic condition satisfied, not satisfied. That is why we told is non-resident, non-resident, non-resident. Here we have written non-resident 21-22, 20-21, 19-20, and 18-19. So till 18-19, he is non-resident. 17-18, he is resident or non-resident if left India for employment. Otherwise, he is resident in 16-17 and 15-16. So 16-17 and 15-16, 14-15, 13-14 also is resident. So with that, he is considered that he stayed for more than, he is considered as resident for more than 2 years out of last 10 years. Further, he stayed in India for more than 730 days in 7 previous year preceding to this year. So if you see here, 17-18, 123 days, and then 16-17, 365 days, and 15-16, 366. So 15-16 is 366. They're going more specific in terms of the leap year. So 15-16 is a leap year of February 2016, comes with the leap year. So 366 that has been considered. So total stay in 7 previous years is 854. Hence, Mr. Vijay is resident and ordinarily resident in India for the assessment year 23-24. So this is the first solution. So any clarifications or any questions on this, you can let me know. Otherwise, we'll proceed to the second sub question in terms of the salary. Now we'll go back and check the question on salary. How is the salary information being given? He furnishes the following. He furnishes following details for previous year 22-23 about his salary income. Basic salary 1,22,000 per month. Dearness allowance eligible for retirement benefit 60,000 per month. Fixed medical allowance 5,000 per month. House rent allowance 25,000 per month. Transport allowance 2,000 per month. Now, don't jump into quick solutions, but look at what is the other aspects. Okay. Bonus 2 months basic salary plus DA. Club membership fee reimbursed by employer 14,000 per annum. Residence telephone bill paid by employer. So 22,000 per annum residence telephone bill is paid per annum, which is a perquisite. And contribution of employer to recognized provident fund 15% of basic salary plus DA. So what is being contributed is basic plus DA of 15%. Now you need to remember that only 12% of basic is allowed. 2 children of Vijay study in the school run by the company. The cost of education in similar school for the year would be 1,24,000 and the employee paid 50,000 to the school by way of fee. So here we'll have to calculate the value of perquisite given and we need to reduce what is considered here. Till here, it is with respect to salary, nothing doing. If you see, Vijay gives following information with respect to 2 loans taken by him. This is all with respect to loans, and the further question goes in terms of the donation and interest, all of those. So we'll come back to this later. Quickly, we'll start computing or look at how the information needs to be considered in terms of the computation of salary. Okay, what is the question given? The basic salary. So let's compute basic salary. So question 1, part 2. So question 1, part 2 talks about the salary computation. So let's put that the computation of income from salary of Mr. Vijay. So the first and foremost thing that they have given is basic salary. So what is given in basic salary is in terms of the amount of the income that he has gained. How much is the basic salary they have given? 1,22,000 per month, correct? 1,22,000 multiplied by 12 months. So that would result in 1,22,000 into 12, which will give 14,64,000. Then moving further, we have dearness allowance. So the dearness allowance, that the fact that the dearness allowance is given in terms of the amount, 7,20,000, that is coming for eligible for retirement benefit fully, 60,000 per month. So dearness allowance forming part of retirement benefit. Okay. So here 60,000 into 12. So this will result into 60,000 into 12, which will become 7,20,000. The next information given is fixed medical allowance. Fixed medical allowance, we have 5,000 multiplied by 12. Okay. So this becomes fully taxable. There is no exemption given. And 60,000 completely taken, 5,000 into 12. And then the next thing that we have is house rent allowance. House rent allowance is something that we need to check if they're following new regime, then no allowance under HRA. If old regime, then allowance is there under the old regime. Now, if we see the question somewhere, last line gives that, or even he has opted the scheme of section 115 BSc on the assumption that he has opted the scheme. So this becomes very critical as to how we are assuming. So there is no requirement for me to calculate what is HRA allowance under section 10 subsection 13. Hence, I will take fully taxable, not allowed under 115, not an eligible allowance under 115 BSc. So 25,000 into 12, entire 3 lakhs will be considered. Then becomes transport allowance, again fully taxable. Transport allowance given is 2,000 rupees. Per month to 12. Here it is 25,000 per month into 12. Fully taxable. The next component that we have is bonus, 2 months basic salary plus DA. So how do we calculate? So here is the quick thing that you need to remember as to you don't go in calculation, 2 months basic and salary DA. So 1,22,000 plus 60,000 is per month basic plus DA into 2. So you need to calculate 1,22,000 plus 60,000 into 2. That will become 3,64,000. Now, once you have computed this, then you have the other benefits that are given in terms of the club membership reimbursement. Now here, whether it is taxable or not is the thing that you will have to look into. Club membership fee reimbursed by employer. So club membership given for the purpose of office activities, then it is exempt. But here you will have to write a note that club membership fee is considered for personal benefit and hence it becomes taxable. Club membership fee reimbursed used for personal purpose becomes taxable. Okay, so this becomes 14,000 per annum. So here you need not multiply, it is given 14,000 per annum. So be careful about per annum information and per month information. Residence bill, residence telephone bill, again, requisite, taxable, 22,000. Then comes contribution, employer to recognized provident fund. Now, here there is a quick note that we need to take. You have to consider this whether it is taxable or not taxable. Since the telephone bill, what they say is if it is a mobile communication, then it is exempt. Telephone, if it is used for personal, it is fully taxable ideally, but there is a kind of a view that is taken that based on the rule 3, they say either personal or the mobile phone or telephone. The objective here is to ensure that mobile phone looks like both official and personal purpose, so it is exempt. But telephone means residence telephone, ideally it will be used for personal purposes. So here the stand taken is that as per rule 3, it is exempt. So you can consider it as exempt even under new regime. Contribution to PF beyond 12%, in excess of 12% is taxable. Now here, if you see what is taxable is what was contributed is 15%. So 3% is taxable. So 3% of basic salary is 14,64,000. 14,64,000 plus DA of 7,20,000. Okay, so this much will become taxable. 3% into 14,64,000 plus 7,20,000. This will give you 65,520. Now, what else is given? Requisite of 2 children of Vijay study in the school run by the company. Now, the cost of the education in the similar school for the year would be 1,24,000. The employee paid 50,000 by way of this. Now, is there any note? Is this taxable? So, 2 children's education, the concessional education is something that we'll have to see. Concessional education facility. Cost incurred 1,24,000 minus recovered of 50,000. So 74,000 become the taxable requisite. So gross salary will be total of all these things 30,85,520. Now, do we stop here? What is the question asked? Is there anything else we need to do? Compute the income from salary. How do we end income from salary? Is this my income? No, this is gross salary. Ideally, under new regime or old regime, you will get standard deduction applicable. In the guideline answer, if you go and check for assessment year 23-24, it is written that standard deduction is not applicable and hence 30,85,520 is the taxable income. However, when we look at this from the perspective of assessment year 24-25, from assessment year 24-25, the standard deduction is applicable under new regime. Okay, so less standard deduction up till AY 23-24 not allowed, but allowed from AY 24-25. Now, any question that you get in this attempt, 50,000 is allowed. Since we are solving this question from the perspective of assessment year 23-24, I am taking it as net salary or income from salary will become 30,85,520. Otherwise, this would have become 30,35,520. So hereby we complete the second sub question also, the computation of income from salary. So let's quickly move to the third question or the information with respect to third question. Vijay gives the following information with respect to 2 loans taken by him from scheduled banks for various purposes. A housing loan of rupees 34 lakhs taken on 12th March 2022 for the purchase of house to be used for self-residence at a cost of 44 lakh. So a housing loan has been taken for 34 lakh. Now here you need to have certain information. Housing loan, 34 lakhs. So this is your question 1, part C. Okay. Housing loan, 34 lakhs. Value of house, 44 lakhs. Now, if you see the loan amount date, loan sanctioned on 12th March 2022. Okay. Value of house is 44 lakhs. The stamp duty value is 41 lakhs. And at the time of purchase, the amount of repayment of loan during 22-23 was, what was the loan repaid during 22-23 is given here in terms of principal is 1,22,000 towards interest 3,62,000. Okay, the first and only residential house owned by Mr. Vijay. Now, if you look at from the provisions of 80E and 80EEA, two new sections were introduced. 80E is applicable for one particular year till 2019, and then this section was further enhanced from 2019 till 2022, 1st April 2019 till 2022 by way of new section introduced under section 80EEA. Now, if we see here, 80EEA was applicable from 1st April 19 till 31st March 2022, and the condition says that the stamp duty value should not exceed 45 lakh and he should not own any other house, and the loan should be sanctioned between this period. Hence, he will get deduction under 80EEA since the loan value or the stamp duty value did not exceed 45 lakh and housing loan is 34 lakhs. So there is no limit on the amount of housing loan under 80EEA. Under 80E, we had that 80EE, we had the housing loan limit. 80EEA, there is no limit on the amount of loan, but there is a restriction or the amount or the size of the house, affordable housing. So we assume that this is taken from the affordable housing. Now, what is the interest paid during FY 22-23 is question given is 3,60,000. Now, out of this, I have options where I can claim the deductions. Principal repaid 1,22,000. That is also given in the question. Correct? 1,22,000. Now, this principal repaid is eligible for deduction under section. Eligible for deduction under section 80C within the overall limit of 1,50,000. Since it is within the overall limit of 1,50,000, it can be claimed. Interest paid can be claimed under two sections. Section 24B under income from house property and section 80EEA. Now it is, let us assume that what can be claimed under section 24B, since it is self-occupied, the maximum under section 24B, the maximum amount of interest allowed in a year to be claimed is 2 lakhs. And anything over and above that, it can be claimed in 80EEA. Otherwise, it can be carried forward to the subsequent year. So since we assume that 24B 2 lakhs is claimed, the balance, that is 3,60,000 minus 2 lakhs, 1,60,000 is eligible to be claimed under this section. But however, this section has an overall limit of 1,50,000. Hence, the permitted allowance under section 80EEA is 1,50,000. Hence, 2 lakhs under 24B and 1,50,000, 1.5 lakh under 80EEA is allowed. Balance 10,000 can be carried forward and it can be claimed in the subsequent year in loss from house property. Okay, so let's quickly see this part of the question. So deduction under section 80C for repayment of home loan, actual subject to maximum 1,50,000. Here deduction we said 1,60,000 is what is eligible to be claimed under 80EE, but however 1,50,000 is allowed. Now moving to the another part of it, a vehicle loan of rupees 18 lakh taken on 29th May 2022 for the purchase of new electric car for personal use. Amount repayment of loan during 22-23 was towards principal 80,000, towards interest 1,75,000. So here again similar, ATEB says that any electric vehicle purchased from 1st April 19 till 31st March 23, maximum you can claim 1,50,000 interest. And since you have 1,75,000, it is restricted to 1,50,000. And what happens to the principal? No deduction under principal. It has to be left out, ignored. Besides these loans, he has also paid a sum of rupees 9 lakh to a political party as contribution. So 80 GGC will come into picture. Deduction under section 80 GGC, 9 lakh to political party. But the entire amount was paid in cash. The beautiful part here is to remember is that any amount paid in excess of 2,000 in cash, any donation is not allowed. Either it is donation to charitable trust or organization or any part of it, it is not allowed. Hence, in the answer, we'll have to write that not allowable since the sum is paid in cash, nil. So deduction under chapter 6A will now become the 1,22,000 of ATC, ATEEA of 1,50,000, ATEEB of 1,50,000, totaling to 4,22,000. And apart from this 4,22,000, we have 24B deduction of 2 lakh. So total deduction I will be entitled for 6,22,000. So this is the overall solution for question number 1. So when you split up, you get clarity in terms of how and simple you can make the solution. Now, if you see the third part, there are 3 different aspects to it. One is the housing loan and the vehicle loan and the political contribution. Under housing loan, you have 2 components. One is 24B and ATEA. So when you split like this, when your thought process get channelized towards a specific provision, it becomes very easy and simple to complete the logical conclusion of the question. Okay, with this, we move to the second question. So the second question is on a partnership form. Hope there are no doubts. If there are any doubts, let me quickly have a quick check on the chat box. I see that there are no questions on the chat box. If there are any questions on the chat box, I would like to request you to kindly put in the chat box, and that will be taken up in the appropriate time manner in order to review and solve the same thing. Now moving to the question number 2. Okay, it is on a partnership form, but it is a PGBP provision. Okay, it is a PGBP provision in terms of the section 35D preliminary expenditure. Very simple problem, small problem, 5 mark. You are easily getting sub question A. BAC and Co is a partnership firm which sets up a new industrial unit in Noida. It incurs following expenditure in connection with the new unit. So what is the new unit? They have incurred around 3 lakhs of project report and market survey of 6 lakh, total 9 lakhs. Further, if you see, following further information is given telling that the cost of the project is 40 lakh and capital employed in the new unit is 45 lakh. Very, very simple. If you know the provision, this is a 2-minute answer. 2 minutes answer. There is nothing more, nothing less in this. Compute the deduction admissible to the firm under section 35D of the Income Tax Act 1961 or the assessment year 22-23. In case of a private limited company or a corporate, it says that you will have to take the cost of project or capital employed, whichever is lower. But here, though the capital employed is given, it is not relevant since it is a partnership firm. Since it is a partnership firm, your focus should remain only on the cost of the project. So the 5% of the cost of the project or the actual expenditure, whichever is lower, will become the eligible expenditure under section 35D. And 35D says that you can claim in the next 5 years in a 1/5 every year. So if we quickly see or we calculate, if you see here, question 2, part A says 5% of the cost of the project or actual expenditure. What is 5% of the cost of the project or actual expenditure? Whichever is lower is eligible for deduction claim under section 35D. But the quantum of deduction under section 35D shall be 1/5 every year. This is very important. Now, if you calculate the part 1 and leave it there, it is not going to help anybody. Okay. So 5% of the cost of the project. What is the cost of the project? 40 lakhs. 40 lakhs into 5% is 2 lakhs. And what is the actual expenditure? 9 lakhs. So which is lower? 2 lakhs is the lower amount. So let's quickly see here. So here, if you see, in case of firm, preliminary expenditure is restricted to 5% of the cost of the project. Further, no deduction shall be admissible unless the accounts of the assessee for the year or the year in which expenditure specified is incurred have been audited by an accountant. So this means that it should be audited and then it can be claimed. The report of such audit by the date prescribed duly signed. So hence, eligible preliminary expenditure is 2 lakh being 5% or actual expenditure 9 lakh, whichever is lower. Hence, eligible preliminary expenditure is 2 lakh. The quantum of deduction. Further, eligible preliminary expenditure is deducted in 5 equal installments beginning the previous year with the commencement of the business or the previous year, whichever is in which the extension is completed. In this case, 2 lakh divided by 1/5, 40,000 is the amount of eligible preliminary expenditure as deduction under section 35D. So this becomes the 1/5, 2 lakh divided by 5. So this is the important aspect that we need to look into. So there ends, this is simple, very simple. Okay. There ends the question number 2, part A. Nothing big or nothing complicated given in this part A. Now moving to the question number 2, part B. Again, very simple question, but if you know the simple aspects of house property, very straightforward question, very simple question. So sometimes if you know basics, you can do in a jiffy. So it is very as simple as that. So here in this question, quickly we will analyze the fact pattern. Varun has to let out properties. So this is let out property. The details of the previous year is given as under municipal value, fair rent, standard rent under the Rent Control Act. Actual rent received is given. Municipal tax due for the year. Municipal tax for the past years paid during the year. And interest on monies borrowed current year paid. Interest on monies borrowed current year not paid. So they've given interest is given, municipal tax is given, actual rent is given, and the gross annual value has to be determined. So municipal value or fair rent, whichever is higher compared with standard rent control, standard rent, whichever is lower, then that will become your the expected rent. Compare with actual rent, take whichever is higher, and then that will become your gross annual value. Once this gross annual value is derived, reduce the municipal tax paid, either pertaining to current year or previous year. The condition here is that it should have been paid. The moment it is paid, it can get the deduction. Then you get the net annual value. On the net annual value, 30% standard deduction under section 24A and interest under section 24B. Interest says that any amount of interest can be claimed, but if it is paid, not paid, two things are given us for us to confuse. The logic here says that both the interest will be claimed. Okay, so let's see here in terms of the calculation. So let's solve this. Since it's simple thing, we'll solve this. Okay, it will not even take 5 minutes. Question number 2, part B. Computation of income from house property. Computation of income from house property. How do we take municipal value? Okay, let me put this municipal value as A and fair rent as B and then standard rent as C. Okay. C. Here let's keep house A and house B. So this is house 1 and this is house 2. Municipal value for house 1 is given as 3,70,000. So let me quickly put the facts: 7,20,000, 3,90,000, 6,80,000, and 3,90,000 of standard rent and 7,20,000 of. Okay. Now we'll have to calculate the expected rent. Expected rent, step 1, A or B, whichever is lower. Lower of the two. What is lower of the two? In this case, it is 3,70,000. In this case, it is 6,80,000. Step 2. Step 1 or C, whichever is higher. Whichever is higher. So I compare 3,70,000 with 3,90,000, whichever is higher, I take 3,90,000. Here I compare again 6,80,000 or 7,20,000, whichever is higher, I take 7,20,000. Then this is my expected rent. Okay, so this is my expected rent. So the reasonably expected rent compared with actual rent received. Actual rent is 6 lakh. Whichever is higher. So gross annual value will be expected rent or actual rent, whichever is higher. So in house number 1, it becomes 6 lakh because though my expected rent is 3,90,000, but I am getting 6 lakh. So I should pay tax on 6 lakh. That whatever I have received. In the second case, though I am receiving only 6 lakhs, I will pay tax on 7,20,000 because my expected rent is 7,20,000. But can I get any exemption here? Can I get any exemption here? Let's see. Is there any exemption that we can get here in terms of? So here in the solution, if you see here, they have written as 7,20,000 municipal value, fair rent of 6,80,000. Higher of the two, they've taken 7,20,000. Standard rent is given. Standard rent, let us see in the question what is given, 6,90,000. Okay, I did take here as 6,80,000. Standard rent is 6,90,000. Okay, sorry. So this is 6,90,000. If this becomes 6,90,000, then I'll have to take, first thing is 7,20,000 or 6,80,000, whichever is lower, that is 6,80,000. 6,80,000 or 6,90,000, whichever is higher, then that is 6,90,000. Then actual rent I will compare with the expected rent, that is 6,90,000. So we'll get 6,90,000 and 6 lakh as gross annual value. So same thing is there till here, expected rent as gross annual value higher from expected rent or actual rent. So in this case, I have received 6 lakh, so 6 lakh is taxable. Here I have received 6 lakh, but my expected rent is 6,90,000, so 6,90,000 will be taxable. Now, with this gross annual value, less municipal taxes paid. So both whatever is paid will be taken. So if you see here, municipal taxes paid during the year, municipal taxes due for the year is 30,000, 1,20,000. What is due, you can leave. But what is actually paid? Municipal tax of past years paid during the year, 37,000 is paid. So this year they have not paid. It is only due. So you will not take 30,000. 1,20,000 is due for the year, but you have not paid. But last year's you have paid this year. So you will take 37,000 and 1,03,000 as your deduction. So minus 37,000 and minus 1,03,500. That will give me net annual value. So very quickly, I will do the calculation of deductions, less deductions. 24A standard deduction, 30%, 5,63,000 into 30%, 5,86,500 into 30%. Then we have 24B, that is interest deduction. What is the interest deduction? Both paid and unpaid, both will be considered. So 3,50,000 plus 1,10,000, both. Okay. So 3,50,000 plus 1,10,000, both will be considered. And then you have 2,70,000 plus 90,000, 2,70,000 plus 1,90,000. Both will be considered. This will give you income or loss from house property. If it is negative, we get loss. Otherwise, it will become income. So how do we get 5,63,000 minus 1,68,900 minus 4,60,000, 65,900 loss and 49,450 of loss. 2,70,000 plus 90,000. I've taken 1,90,000. So we get 50,550 of profit from house 2 and 65,900 of loss from house 1. Together, if I see from the head of income, so this is house wise. from the net, if I see 65,900 loss and 50,550, net I have 15,350 of loss from the income from house property. Compute the income under the head house property in the hands of Varun for assessment year 23-24, assuming none opted to pay tax under section 115 BAC. So yes, opted for outside 115 BAC, not opted. So this is the solution for your question number 2, part B. Very simple. Any questions still here? So let me quickly have a look at chat box. Looks like everything going fine and there is no questions. So let me proceed to question number part C of question number 2. What is question number 2 part C looking at? Question number 2 part C is looking at the clubbing income, clubbing provisions. So here quickly, if we read the question, Geet and Jeet are 2 minor sons of Raghav and Riya. So parents are Raghav and Riya. Business income of Raghav is 3,40,000 and salary income computed of Riya is 2,50,000. So they have given income of both. So the higher income, the income of higher, whichever is the parent's income, whosoever is higher. So whichever parent is getting higher income will be considered for that clubbing. So in this case, Raghav's income is higher. So Raghav's income, it will be clubbed in the hands of Raghav. Income from Geet and Jeet from stage acting is rupees 60,000 and 70,000 respectively. Besides interest on company deposits of Geet and Jeet, deposit was made out of income from acting are rupees 40,000 and 1,000 respectively. Geet and Jeet have also received the following birthday gifts during the financial year 22-23. On 20th August 2022, gift received from by Jeet from his grandfather, 75,000. So this is a gift from relative, not taxable. So income from other source provision is also clubbed here. On 14th November 2022, gift received by Geet of rupees 60,000 from Riya's friend and rupees 80,000 from Riya's sister. So you'll have to look at who is relative and who is not relative. Riya's friend is not relative. Riya's sister is relative. So 80,000 is not taxable. 60,000 is taxable because it is more than 50,000. Up to 50,000 gift can be received and it will be clubbed in the hands of the parent whose income is higher. Compute the total income of Raghav, Riya, Geet and Jeet for the assessment year 23-24. Assuming that Raghav, Riya, Geet and Jeet does not opt to pay tax under section 115 BAC. Now let's quickly see the solution here. So income from salary computed, 2,50,000 is taken for Riya and income from business for Raghav given is 3,50,000. So these two things are given, you'll have to take it. Now the next thing is income from stage acting. This is the income of Geet and Jeet. It will be taxed in their hands only, 60,000 and 70,000. Interest from company deposit received by Geet to be clubbed in the hands of Raghav after exemption of 1,500. So what we have here is 40,000. That income should be clubbed and 1,000 of Jeet should be clubbed. But 1,000 each, we have section 10 subsection 32 gives the minor deduction. Section 10 gives the deduction of 1,500 per child. So 40,000 minus 1,500 is 38,500. Now, interest income from Jeet, it is 1,500 or 1,000, whichever is lower. So 1,500 is the maximum deduction that can be claimed. 1,000 is the amount of income to be clubbed, which will be completely given as a deduction under section 10. Thereby, there is no income to be clubbed in the hands of the Jeet. So that becomes the clubbing provision cleared. Gift received by Jeet on 20th August, gift from relative is not taxable. So this income of 75,000 received from grandfather is not clubbed, not taxable. Gift received by Geet on Riya, 14 November from Riya's friend to be clubbed in the hands of Raghav. So 60,000 will be clubbed. But at the same time, received from Riya's sister, that is not clubbed because it is relative. So once you calculate this, 3,40,000 for Raghav's salary, 38,500 and 60,000, it becomes 4,38,500. And for Riya, nothing is clubbed, only 2,50,000. For Geet and Jeet, whatever they have earned from stage acting, 60,000 and 70,000, that will be considered as income from other sources. So this is the total income. So this is not income from other sources because this includes income from salary and income from business also. This is not the right way that is given in the guideline answer. This is the total income taxable. 4,38,000, including income from other source, income from salary, and income from business. 4,38,000 is total income of Raghav. 2,50,000 is total income of Ria, and 60,000 is total income of Geet, and 70,000 is total income of the Jeet. So that is, thereby we come to the end of the question number 2. Now, if you see from the perspective of timing, we are at 1 hour since we started. We have completed 2 questions. Though prima facie, we took more number of minutes for solving question number 1. Question number 2 did not take much time. That is the kind of fact that you will have to see from the examination also. You need to answer 6 questions. That means you have 30 minutes per question. So 30 minutes per question and 3 sub-questions in every question for 5 marks. For every 5 marks, you have 10 minutes. So that means every 1 mark, you have 2 minutes. So that is the kind of finer timeline that you can manage. So at 8 o'clock or at 1 hour from the time that we have started, we have completed 2 questions. So we are on time. Now that we are interacting and we are doing a lot of things, and the time that we have matched also is equivalent to the time that you write and solve. Okay. So that compensates with the time of discussion and explanation with the time that you are required to write in the examination. Let's move to the next question. Question number 3 is now coming in terms of the set off and carry forward of losses. Now we have completed, till now, we have completed around 6 sub-questions. And with 6 sub-questions, we have covered residential status, we have covered income from salary, income from business or profession with respect to section 35D, and the income from house property. And we have covered in terms of the deductions on chapter 6A. And previously, the last question we have covered in terms of the clubbing provisions. Now that you have another question, which is asking on a provisions from set off and carry forward of losses. So Nisha, a resident individual, provides following details of her income or losses for the year ended 31st March 2023. Now that we have different things, we need to be clear in terms of what is the current year loss and what is the current year income, which can be set off within the head of income. And what is that loss which can be set off with other heads of income during the current year? And what is that loss which can be set off from the which is brought forward from earlier year that can be set off from the same head of income in the current year? So very quickly, we should be aware of these kind of provisions. The moment you are thorough with the provisions, it will be very easy to solve. First and foremost, it is given as long-term capital gain on sale of equity shares computed in accordance with section 112A, 9,95,000. So this is the gain. Interest on fixed deposit given as 73,000. That is again an income. Loss from sugar business. So this is the loss, 8,70,000 from business. Speculation profit. This is a speculation business income, 2,40,000. Lottery income net of TDS, 75,000. And then you have loss incurred by the firm in which she is a partner, 1,60,000. Again, loss from business. Salary received as partner from partnership firm. The same was allowed to the firm. So this is again business income, 60,000. Brought forward short-term capital loss on sale of gold. This is 2,30,000. So this is brought forward loss, not the current year loss. The moment you see brought forward loss, it means that during the year it can be set off only against that head of income. So very straightforwardly it should hit your head. Brought forward loss on sale of equity shares of nature specified under section 101, 111A. Here we look at that the concept of the short-term capital gain, short-term capital loss brought forward. So capital loss can be set off against capital gain of the current year. Short-term capital loss can be set off against both short-term capital gain and long-term capital gain, 25,000. Compute the gross total income of Nisha for the assessment year 23-24 and the amount of loss that can be carried forward, assuming that she does not opt for, to pay taxes under 115 BAC. So first thing, we'll have to go head by head. Is there any income from salary? The first head of income. There is no information about income from salary. Is there any income from house property? There is no information about income from house property. The third head of income is income from business or profession. Is there any information about income from business? Yes, we have loss from sugar business. We have speculation profit. We have the loss incurred in the hands of partner and salary received as partner. So these are the 4 things that we have in terms of the business. Now, first and foremost, let's take, so question number 3. Part A. So what we have here is income from business. The first and foremost is salary received from firm. How much is the salary received from the firm? 60,000. And then we have speculation profit. So that is the speculation profit. So that is a different business. So under income from business, you'll have to take normal business or regular business and speculative separately. Speculative business is having a loss, and that loss can be set off only against speculative profits. So this loss cannot be set off and this loss to be carry forward. But here we have speculation profit. Okay, so this is not a loss. But speculation business profit can be set off against the loss of other businesses. So profit of 2,40,000 is available here, and salary received is 60,000. Apart from this, we have loss incurred by the firm in which she's a partner. So loss incurred by the firm, we have the note given. So let's quickly refer to the note in which she's a partner. Loss from partnership firm cannot be set off against the business income since share of income of the firm is exempt. Since the income is exempt, the loss from the share of the profit of the firm is not eligible. So I cannot set off this here. So that loss is ineligible. Loss from firm is not eligible. Okay, thereby my income from business will be sufficient enough to 3 lakhs. But if I have one more business, loss from sugar business, 8,70,000. That is again normal business. So less or loss from sugar business. This is again a normal business, 8,70,000. Out of this 8,70,000, this 3 lakh will get adjusted. Okay. Set off of current year profit 3 lakh from same head of income, intra-head adjustment, balance loss of 5,70,000. Let's see if this can adjust with any other head of income. Otherwise, this will be carried forward. So balance loss, we have only capital gain related profit. So it will not obviously let's see if it gets set off or not. Okay. So balance loss 8,70,000, that is 5,70,000 to be set off from income from other sources to the extent of 73,000 and remaining loss from income from the head capital gain. The business loss can be set off against any other head of income except the salary income. Okay. So what we have is the income from other source. Where is income from other source? We have interest income, fixed deposit. So that fixed deposit will be set off. Income from fixed deposit is 73,000 less set off against the loss of business 73,000. So nothing is taxable. Here also, let's keep this like this, 3 lakh and less set off against business loss of sugar, 3 lakh. So no income, no taxable income, 0. Okay, so loss from sugar business, we have 5,70,000. So less set off from other sources, IFOS, interhead of current year, interhead adjustment, same here, same previous year. So less 73,000. So what is the balance loss? We have balance loss. We have 5,70,000 minus 73, 4,97,000. Now, then comes capital gains. So this is income from other source. So ideally, this should have come in the last. So let's put in between here, income from capital gains. What is income from capital gains? So we have three things. One is long-term capital gain under section 112A, 9,95,000. And then I have speculation loss. That's it. And then I have brought forward short-term capital loss, brought forward short-term capital loss from sale of gold, and brought forward short-term capital loss on sale of shares under section 111A. Both of this can be set off 2,30,000 and 25,000. So both of this will get set off. Balance capital gain that is available to be taxed. 9,95,000, 2,30,000 minus 2,50,000, 7,40,000 is available. Now, you see here what they have given. If you see, there is one more thing. Brought forward loss on sale of equity share under section 111 is 25,000. This is 7,50,000. Less. This also can be set off against the loss of business, 4,97,000. Okay. So the balance capital gain is 2,43,000 taxable. So this will come on the outside box. So here this 4,97,000 that we had is less set off from income from CG, income from capital gain, 4,97,000. So there is no loss to be carried forward, 0. So this loss of 8,70,000 is completely adjusted in the current year itself. So nothing to carry forward. Okay. And this income is already adjusted. Nothing is taxable. Now coming to the income from capital gain, we brought forward loss and adjusted current year business loss, and balance 2,43,000 is there, which needs to be taxable. Income from other source adjusted, nothing is there. So thereby, what else we have been left out? Winning from lottery, one thing is there. Net of TDS. So this cannot be adjusted. So this has to be taken gross. So winning from lottery cannot be adjusted against any loss. So winning from lottery, you have net is 75,000. That means 75,000 is after 30%, that is 70%. You need to calculate how much is 100%. So 75,000 divided by 70% will give you 1,07,143. So this 1,07,143 will be taxable. Thereby, my gross total income will become 2,43,000 plus 1,07,143 will become 3,50,143. So this is the overall approach that you will follow for looking at the set off and clubbing provisions. So here we complete the part A of question number 3. We'll quickly proceed to question number 3, part B. So very simple. Again, here partnership firm and business income is coming into picture. So assessment of a partnership firm. SM Services, a partnership firm, consists of 2 working partners, Sunil and Murthy, with 60% and 40% share respectively. As per the partnership deed, they are eligible for interest on capital at 15% per annum on their capital contribution of rupees 18 lakh each, and remuneration of rupees 55,000 per month to Sunil and 45,000 per month to Murthy. The firm is engaged in manufacturing business. During the year ended 31st March 2023, the net profit as per the profit and loss account was 25,36,000 before considering interest on capital and remuneration. Very clearly, they've given the partners profit sharing ratio 60%, 40%. That interest on capital that they're eligible is 15% on 18 lakhs of capital contribution each, and a salary of 55,000 per month to Sunil and 45,000 per month to Murthy. And before giving interest on capital and remuneration, the profit for the firm was 25,36,000. Now, what are we supposed to calculate? They have given certain following information. That current year revenue expenditure on scientific research, 2,20,000. Brought forward business loss of assessment year 18-19 is 32,000. Brought forward business loss of assessment year 14-15 is 40,000. Unabsorbed depreciation of assessment year 11-12 is 58,000. Unabsorbed capital expenditure on scientific research relating to previous year 19-20, 75,000. Current year capital expenditure on scientific research 4,25,000. Current year depreciation under section 32 is 3,72,000. All of this is doing to in terms of capital expenditure and business loss. Again, we are coming to combination of partnership provisions, section 40B, interest on capital computation, eligible partnership remuneration, and we are also coming to the point where we are looking at the section 35(1)(4) and 35(1)(1) expenditure and set off and carry forward losses eligibility. Let us quickly calculate this. Okay. Question number 3, part B. So what is question number 3, part B talking about? Computation of book profit and computation of taxable income of SM services. First thing, profit as per P&L account. Now from this, what all is eligible? 25 lakh profit as per P&L account given is 25,36,000. Out of 25,36,000, first thing is less interest on capital up to 12%. Interest on capital allowed is 12% as per Partnership Act. So 12% on 18 lakhs each into 12% into 2. Okay, so this will become 18 lakhs into 12% into 2. That will give 4,32,000 as an eligible expenditure. Then less current year revenue expenditure on scientific research. This is section 35, subsection 1, clause 1. How much is the scientific research capital expenditure? We have revenue expenditure 2,20,000. After this, less current year capital expenditure, that is also allowed. Expenditure on scientific research under section 35, subsection 1, clause 4. So this is giving you 4,25,000. Now, what is the other aspect that you need to understand here is that after this, what is the sequence? So we'll have to arrive. When should you arrive the calculate the book profit, or how will you calculate the eligible remuneration to the partnership remuneration or the partner remuneration? You calculate based on the book profit. For book profit, except for brought forward business loss, you adjust everything. Except for brought forward business loss, you adjust everything. So you need to calculate the adjustment of unabsorbed capital expenditure and current year depreciation. So less current year depreciation. So that is 3,72,000. And then you have unabsorbed capital expenditure of previous year. Okay, unabsorbed capital expenditure of previous year. Unabsorbed capital expenditure of previous year, that is 75,000. And you have one more thing, unabsorbed depreciation of previous year, less unabsorbed depreciation of previous year, that is 58,000. Till here, whatever we do, so these are the amounts that you are subtracting. Okay. Let me keep this or less. That will give you 9,54,000. So this is called as book profits. On this book profits, you're eligible for partner remuneration. What is eligible? Partner remuneration under section 40B. What do we calculate? How do we calculate? First, 3 lakhs, 90%, and balance 6,54,000, 60%. How much is that? 2,70,000 plus 6,54,000 into 60%. How much is eligible? So they're eligible for 6,62,400. So this is eligible partner remuneration. What is actual? If actual is lesser, you will take actual. Actual partner remuneration for partner. Who are the two partners that we have? Sunil and Murthy. So for Sunil, it was 55,000 per month into 12, and Murthy, it is 40,000 into 12, right? What is that? They're given 45 and 55. Okay. So this will become 55,000 into 12 and 45,000 to 12. That will become 5,40,000. So total remuneration that they've taken, actual remuneration, if you add these two, is 12 lakhs. So what is that they're eligible? They're eligible for only 6,62,400. So from the book profits, less eligible remuneration, and you get the taxable business income for current year, okay, before set off. So that will become 9,54,000 minus 6,62,400, 2,91,600 less brought forward business loss. This is the last adjustment that you do. Business loss, you have 2 years. One is 18-19 and 14-15. Assessment year 18-19 and assessment year 14-15. So we are in assessment year 23-24. For assessment year 23-24, this 8-year period is lapsed. 8-year period is lapsed and not eligible to be claimed. This is within the 8-year period, so you claim that. So 18-19 is 32,000. So you claim 32,000. 14-15, no adjustment. So taxable business income for current year post set off 2,91,000 minus 32,000, 2,59,600. So this is your end part. What is that they've asked? They've asked required to compute total income. So this is the total income, basically. Total income of SM services is 2,59,600. So let's see here, 2,59,600. Same thing that you have, 8 years, not since it is lapsed, not allowed. Okay. So question number 3, part C is clear. Any questions still here? So let me quickly have a look at the live chat. Any questions, kindly start putting into the live chat. I have here on the side on my system that there is a chat box open. So I can quickly have a look at any questions that you have, and then we can answer on those questions. Thereby, we come to the end of question number 3, part B. Quickly, we'll move to the part C of question number 3. Now, this talks about computation on deduction, overall assessment of an individual. Rajendra, aged 47 years, a resident individual engaged in a retail business of stationery products, furnishes the following particulars of his income for the previous year 22-23. So he has income from business of 15,10,000. LIC premium paid for dependent father aged 75 years, 25,000. Question here is to see that whether LIC premium paid for dependent father is allowed or not. Yes, it is allowed for self, spouse, children, and parents in case of medical insurance. But LIC premium very clearly says self, spouse, and children. Dependent parents not allowed. Interest received from public provident fund, income from other source of 15,000, interest from bank on savings bank account 22,000, deposit in public provident fund 1,30,000. So here we are having two things. One is ATC PPF contribution 1,30,000 and ATTTA interest from savings bank account 22,000. Now here we should see whether he is going for new regime or old regime. You are required to calculate his tax liability and advise him whether he should opt for alternative tax regime under section 115 BAC or not for the assessment here. Now here we need to calculate if he is opting for new regime and the old regime, what is the difference? Okay, so LIC premium not allowed as a deduction. So under new regime, deductions are not allowed, but tax rate is high. Under old regime, deductions are allowed, but the tax rate is low. Okay, so question number 3, part C. So one of you are asking that, can you list any points that should be carefully checked before answering the question? So before answering the question, like I said, look at the perspective. So this we need not. So here they're asking both. If somebody read that you are required to calculate tax liability and advise him whether he should, whether if you miss this word, whether he should, if you're required to calculate tax liability, alternative tax regime under section 115 ASBC. So you will think that you'll assume and you will jump to calculate only 115 BAC and come back. And then you will see either you would have calculated under new regime or you would have calculated under old regime. So reading this end part, what is that they're expecting is the main thing. And then look at the facts. Now LIC premium paid for dependent father. So the moment if you don't read and if you stop reading at LIC premium 25,000 ATC, if you forget to see to whom it is paid, then it becomes very difficult that though you know that LIC premium under ATC is allowable only for self, spouse and children, then you will not get a chance to evaluate that it is paid to dependent father, so it is not allowed. So your conclusion will go wrong and you will give deduction for 25,000. So these kind of things, mainly focusing on the important information is very critical. Computation of income and tax liability for Mr. Rajendra. Okay. So we'll do both side by side, old regime versus new. 115 BAC opted out. Opted out means old regime. 115 BAC not opted out. That means new regime. So this is new regime and this is old regime. Okay, so we have these two options. Now, first thing is income from business. Income flow will not change irrespective of the kind of regime, both will be same. Then less deductions. ATC, which all ATC deduction is eligible? ATC, LIC, not eligible. If 115 BAC is opted out, this is not eligible, 0. If he had not opted out anyhow, under new regime, it is not at all applicable. Then comes interest received from public provident fund. So this is another income. Interest from public provident fund. Interest from public provident fund is exempt. Okay, interest from public provident fund is exempt. So you need to take that exemption into consideration. Both under new regime and old regime, it is not taxable. 0. Okay, then comes interest from bank on savings bank account. Interest from savings bank account. In both the case, it will be 22,000. And then we have, that's all. So this is your gross total income. 15 lakh 32, 15 lakh 32. Then you have deduction under section 80 TTA. Up to 10,000 it is eligible. Under old regime you get 10,000, but under new regime not applicable. Okay, under new regime not applicable. Then you have deposit in, there's one more ATC, you have PPF 1,30,000 eligible under old regime, under new regime not applicable. So then what else you have? That's it. Then this will give you total deductions and then you have net total income. 15 lakh 32 minus 1 lakh 30 minus 10,000, 13 lakh 92. Here it will be 15 lakh 32 only, no deductions. So this is your old regime income. This is your new regime. Sorry, this is your old regime 13 lakh 92, new regime 15 lakh 32. So let's quickly calculate tax liability under old regime. If opted out of 115 BAC. Total income or taxable income will be 13,92,000. Computation of tax up to 2,50,000 nil, 2,50,000 to 5 lakh, 5%. That will become 5% of 2,50,000. 12,500. 5 lakh to 10 lakh, 20%. That will become 20% of 5 lakhs. Then 10 lakh 1 to 13 lakh 92,000. It is 30%. So 3 lakh 92,000 into 30%, 1,17,000. Okay. So this is my total tax before surcharge and cess. So this is basic tax. Add surcharge if applicable, and here it is not applicable, 0. Add cess of 4%, 2,30,100 into 4%. Total tax payable will be 2,30,000 plus 0 plus 9,240, 2,39,304. Tax liability under new regime. If not opted out of 115 BAC. Same thing, but different slab rates, correct? We'll start from here. Up to 3 lakh, it is nil. Up to 3 lakhs, it is nil. Then what happens? 3 lakh 1 till 6 lakhs, 5%. How much is 3 lakhs into 5%? Okay. So this is what I am solving for, applicable from 23-24. Until 23-24, this was 2,50,000 only. So now I am changing this. Okay. So I am solving this as per applicable for taxable income or tax computation for assessment year 23-24. Okay. This will differ from your guideline answer. 3 lakh to 6 lakh, 5%. 6 lakh to 9 lakh, 10%. 9 lakh 1 to 12 lakh, 15%. 12 lakh 1 to 15 lakh, 20%. 15 lakh and above, it is 30%. Okay, 5, 10, 15, 20, and 30. Now, here it is 3 lakhs into 5%. Here again it is 3 lakhs into 10%. Here again it is 3 lakh into 15%. And here it is 13,92,000 minus 12 lakhs. That is 1,92,000 into 20%. This will become 38,400. This is not applicable. So the total tax will become 1,28,400 basic tax. Add surcharge, not applicable. Cess into 4%. Total tax. So here it becomes 1,33,536 versus 2,39,304. So your conclusion should be that it is beneficial for, you see here they given gross total income as per regular provisions here. In the instant case, tax liability under Section 115 BAC is lower, hence it is advisable to opt for provision of Section 115 BAC. So even if you solve from previous slab rates, the same thing. Now also you are getting the same benefit, that the tax liability under Section 115 BAC is lesser. Thereby, you can go ahead with 115 BAC option, that is new regime, without claiming the benefit of deductions. So thereby, we come to the end of question number 3. Now moving to question number 4. Question number 4 has two alternative questions. Okay, 4 or 4A. Okay, 4 has 3 sub questions and 4A has 3 sub questions. Okay, let us quickly see the provisions here and see here what is the expectation that they are having. Now, usually 1, 2, 3 will be completely practical questions solving what is required to be solved. And from the perspective of question number 4, slightly it will be theoretical. Slightly it will be theoretical, and it can be any small concept and any nook and corner, any chapter that can come into picture. Question number 1, 2, 3, predominantly it can be on your 5 heads of income plus deductions plus carry forward, set off and carry forward of losses, clubbing provisions, and residential status, computation of tax liability, and even it can be TDS provisions. So these are the chapters that can be possibly focused in question number 1, 2, and 3. Question number 4 will be on procedural aspects in terms of the due dates, return filing, payment of tax, TDS provision. In the previous year, December 2023, the TDS provision is taken in question number 4. And what are the timelines? These are the theoretical questions that can come in question number 4. And now you can evaluate which question you can write, 4 or 4A. So it is left to you whether to write 4 or 4A, whichever is more easier and whichever is more relatable to you, you can opt writing that. Okay. So let's see question number 4. Explain the term return of loss under the Income Tax Act 1961. Can any loss be carried forward even if return of loss has not been filed as required under Section 139(3) of the Income Tax Act 1961? Now, this is a 5-mark question. Very simple answer, that income from house property or the loss from house property and unobserved depreciation can be carried forward even if return of loss is not filed within due date. But however, the return of loss is mandatorily required to carry forward loss under business, loss under speculation business, loss under capital gain, loss from other sources, loss from winning and winning from resources, or loss from owning and maintaining resources. So these are the 5 incomes where if you have loss, you need to file return within due date. So you need to write the provision first for what it is applicable. Otherwise, it will not be difficult. Okay. In the interest, I think some of you are asking to explain in Kannada, but specifically where you are finding challenge, we can explain. But in the interest of the audience at the overall, the people are being at length and breadth of the country. So it is most suitable language is English. So if there's any specific thing that you want to be explained, you can reach out to us on WhatsApp and we can try to connect and look into it. Now, moving further in terms of the solution here, if you see the guideline answer, question number 4, if you see here how they've given that, tell that Section 139(3) deals with loss of return, and it says that no loss can be carried forward. The return is not filed within the due date. Now, what are those loss? Business loss, speculation business loss, loss from specified business, loss from capital gain, and loss from owning and maintaining resources to be carried forward under Section 74A(3). So these are the things that cannot be carried forward if the return of loss not filed within due date. What is the due date? 31st July, 31st October, and 30th November. 30th November is applicable for cases where transfer pricing is applicable. Where a case is applicable for tax audit, the due date for filing return of income is 31st October, and where none of the audits are applicable, 31st July. So this is the thing. Now, this is the background that you'll have to build up for 5 marks. Otherwise, your answer is only so much. I will show you here what is the answer. This is the only answer. The loss from house property to be carried forward under Section 71B and unobserved depreciation under Section 32 can be carried forward even if return of loss has not been filed within 139.3. The question here is only two-liner answer. But in order to get that 5 marks, you'll have to give some background. Explain the term return of loss. Okay. This is the thing which we will miss out. They're asking what is return of loss? Which provision is talking about return of loss? Can any loss be carried forward even if return of loss has not been filed? Yes, that is loss from house property and unabsorbed depreciation. But if you are in a hurry, so some of you asked that what are that we should be aware of? How do we read the question? So here is what you can read the question. Many of the students will miss out the first statement and look at that the question is only can any loss be carried forward? Then write only this much and come. If you write only this much and come, then you will not get 5 marks, you will get only 2 marks. In order to get 5 marks, you will have to write what is a return of loss, which provision is telling, which loss cannot be carried forward. This is the main question here. This is the main question here. Okay, so keep in mind and be careful how you will look into it. Then coming to question number 4B, income deemed to accrue or arise in India to a non-resident by way of interest, royalty, and fees for technical services is to be taxed irrespective of territorial nexus. Examine the correctness or otherwise of the statement with reference to the provisions of the Income Tax Act. So here, this is talking about the deemed income provisions. Yes, the statement is correct. So India follows 2 types of taxation. One is source-based taxation and resident-based taxation, irrespective of the territorial nexus. Territorial nexus means whether it is earned in India or outside India. So that brings the deeming fiction. The characteristic of deeming fiction is always there in the Income Tax Act. Only act which has the lot of deeming fiction in the both GST and income tax compared is income tax, where thereby they say that whether income is not accrued, though the income is not received, though the income is not earned in India, but if it is deemed to accrue or arise in India, it is going to be taxed in case of non-resident if it is in India. So the answer is very simple, that they're given the statement is correct. As per explanation to Section 9 of the Income Tax Act, income by way of interest, royalty, or fees for technical services which is deemed to accrue or arise in India shall be taxable in case of a non-resident, whether or not non-resident has a place of business in India or non-resident has rendered services in India. So it does not matter whether he has a business in India. It does not matter whether he has provided the services in India. It does not matter. It is completely looking at from the perspective of deemed to accrue or arise in India. Section 5, scope of total income, very clearly says for a non-resident, it is taxable that if it is deemed to accrue or arise in India. 4 things: received in India, accrued in India, deemed to accrue or arise in India, and deemed to be received in India. These 4 things is taxable even for non-resident, irrespective whether he has place of business in India or whether he has rendered any service or conducted any business in India. Does not matter. It becomes taxable. So that is the sum and substance of this question, and that is how you will have to structure your answer. Moving to the 4th question, part C. Deepak furnished that return of income for the assessment year 23-24 on 22nd July 23. Due to missing information for payment of taxes in the return of income, the assessing officer considers it defective under section 139(9). So the 2 sub-questions that they're asking, what are the consequences if defect is not rectified within the time allowed? And they have told specify the remedies available if defect not rectified within time allowed by the assessing officer. So if the section 139(9) says that if there is any defect in the income tax return, the communication will come from the tax office, and from the date of receipt of communication within 15 days, it is the responsibility of the assessee to rectify the defect or correct the defect. Okay, that is the timeline given. If assessee or Deepak does not rectify this defect within the 15 days timeline given, then it becomes that as if Deepak has not at all filed the return. Why? Because the return filed become invalid. It becomes invalidated. The moment it becomes invalidated, it is as good as that he has not at all filed the return of income. Moving further, specify the remedies available. What happens if the defect is not rectified within the time allowed? Then you'll have to take additional time and you'll have to get the condonation of delay. What is a condonation of delay? Make an application to the assessing officer telling that why you are not able to rectify. And if additional time is given by the assessing officer, then it can be defect can be cured. If time is not given, then you will have to make an application for filing a delayed return of income, because the return that you had filed is cancelled. It is as good as that you have not filed the return of income. Thereby, it becomes that you will have to make an application for filing a delayed filing of a return, and these are the remedies that are available. So I think similar line, the answers are given here also, that you can read through this, and that is all about the first alternative question that you have, 3 parts of 4A, B, and C. If you see here, all the procedural aspects are asked, and the scope of total income question is asked from chapter number 1 and 2, and return of loss from chapter number 12 and 13. And then you have the consequences, again, return filing chapter. Now moving to question number 4A, alternative question. So here they have given quickly 3 sub-questions again, or okay, 3 sub-questions. And the first question is dealing with the TDS provisions. Examine the applicability of tax provisions or applicability of tax reduction at the source provision, the rate of TDS and the amount of TDS in the independent following cases for the assessment year. 3 things that you'll have to look at it. Very clearly, they're asking what is the section under which the TDS should be deducted, and the provision has to be explained. And they're asking what is the tax deduction at source rate of TDS and the amount of TDS. That means you need to calculate the amount of TDS and give it in your answer. First one, there are 5 scenarios. Payment made by company to Shanti Lal, subcontractor, rupees 3,50,000 with outstanding balance of 1,50,000, shown in the books as on 31st March 2023. Now, section 194C applies to the contractor payments, and contractor payment says that any overall limit during the year exceeding 1 lakh or single payment exceeding 30,000 will attract TDS under section 194C. Here, on due basis or payment basis, whichever is earlier, on both the TDS will be made. Here, 2 things are there. One payment is made 3,50,000 and one due is created for 1,50,000. Thereby, total on which TDS will be applicable is 5 lakhs at 1%. Payment made to Shanti Lal. Shanti Lal is an individual. TDS rates vary 1% or 2%. 1% is applicable when a payment is made to individual, and 2% is applicable when payment is made to other than individual. Now, in this case, since it is made to Shanti Lal, an individual, 5 lakh, 1% TDS will be equivalent to 5,000, and the applicable section is 194C. So I am giving you the rate source provision, that is 194C. I've explained the provision. I've given the rate 1%. I've given the amount 5,000. Second one, fee paid on 1st January 2023 to Dr. Banawat by Kishan HUF, rupees 40,000 for surgery performed on a member of on the family. So Dr. Banawat is the doctor who paid it by Kishan HUF. Why he paid? A member of the HUF had a medical surgery required to be done. Based on that, a surgery was performed. Now, this is a professional fees. Now, 40,000 professional fees is coming under section 194J. 194J is applicable when TDS is deducted at 10% if the fee is more than 30,000. But the 194J says if it is applicable for personal purposes, then no TDS deduction. Thereby, you need to write a note that since the treatment or professional services is availed for the purposes of personal performance, then TDS is not applicable. Point number 3, Dhanapal wishes to purchase a residential house costing rupees 60 lakh from Priya. The house is situated at Mumbai. Both the buyers as well as sellers are resident in India. So this provision applies to resident purchase. Hence, 194IA is applicable. Section 194IA very clearly says that if the value of the house property purchase is more than 50 lakhs, the stamp duty value of the property. Here they've given the stamp duty value is not given. The provision says that the stamp duty value is more than 50,000. Let's assume that the stamp duty value is more than 50 lakhs. Then 1% TDS needs to be deducted. Section is 194IA. The purchase value should be more than 50 lakh and it should be deducted at 1%. So 60 lakhs into 1% is 60,000 is the value of TDS. Moving to the fourth transaction, Arun has paid rupees 5 lakh on 12th October 2022 to Cool Cold Storage Private Limited for preservation of fruits and vegetables. He is engaged in the wholesale business of fruits and vegetables in India, having turnover of rupees 4 crore during the previous year. So say this will, students will get confused whether this is a rent payment, which applies TDS under section 194I, or whether this is contract 194C. So this is more of in nature of contract, and section 194C is applicable, and the 194C is applicable at the rate of 2% or 1%. So this is a private limited. Since it is a private limited, you'll have to deduct TDS at 2%. What is the amount paid? 5 lakh. 5 lakh into 2% is 10,000 rupees. Why the turnover limit is given 4 crore? The turnover limit of 4 crore is given because section 194C says for an individual, 194C provisions are not applicable if the turnover for the previous year is less than 1 crore. If it is more than 1 crore, then the TDS provisions is applicable in the current year. Moving to the fifth transaction, Ravi, a salaried individual, has paid rent of rupees 65,000 per month to Rajiv from 1st August 2022 to 31st March 2023. Rajiv has not furnished his permanent account number. Now here are two things that needs to happen. Section 194 IB is applicable. IB says that to whomsoever section 194I is not applicable, 194 IB will be applicable. If the rent paid for the property is more than 50,000 per month, the TDS rate is 5%. But if PAN number is not available, TDS rate is 20%. And when do you deduct the TDS? You need to deduct the TDS on the last month of the financial year, that is March, or in the month in which you vacate the property. Now, August to March, it is not full year. Okay. April, May, June, July, 4 months you are not there. That means out of 12 months from August to March, it is 8 months. 8 into 65,000. 8 into 65,000 is the amount that you need to calculate as the rent paid. So if you see 8 months rent of 65,000 per month, so the total rent paid will become 65,000 into 8, 5,20,000. For this, the TDS would have been 5% if the PAN is given. That means it would have become 26,000. From the last March month, 65,000, you would have deducted 26,000 and paid 39,000 rent for March month. But in this case, since the PAN is not given, the TDS will go at 20%. That is 1,04,000. But the provision says you need to deduct TDS from the last month of the financial year in which the rent is paid, that is 65,000. That is what you are paying in March. How can you deduct 1,04,000? So the provision says maximum that you can deduct is the last month rent. So 65,000 will become the amount of TDS under section 194 IC. And what you pay for the March month is 0 to the landlord. So March month rent that you pay to the landlord is 0. Yes, so quickly you can see the solution here. 65,000, it says it is restricted. Maximum cannot exceed 65,000 being rent for the March, and accordingly you will leave it there. So this is your question number 4A part 1. Question number 4A part 2 talks about a scenario where different individuals are involved and the tax implication of different individuals are taken care here. So what is the scenario here? It is on a capital gain and it is on a both business provision and capital gain provision. Now here we need to see Ajay, a property dealer. So Ajay is a business person. So that is what should trigger your mind quickly. Ajay is a business person. Entered into an agreement with Mukesh to sell a property on 6th April 2022 for 55 lakh. So he has entered into an agreement to sell 55 lakh. He received an advance of rupees 12 lakh with the date of agreement by account paycheck. Transfer took place on 12th September 2022. The valuation determined by Stamp Valuation Authority on the date of agreement and the date of transfer was different. So 59 lakh was on date of agreement and the date of transfer, that is on 12th September, it is 65 lakh. So from April till September, the value of stamp duty has increased from 59 lakh to 63 lakhs. And actually Mukesh sold. So this Mukesh is purchasing from Ajay. What he purchased in September 2022, he sold to Deepthi for 65 lakhs. So that we'll see later. Okay, that is one fact. The valuation as per Stamp Valuation Authority as on March 2023, 64 lakhs. So this is the entire transaction. Ajay is a property dealer. Mukesh is buying from Ajay, and Mukesh is selling to Deepti. And these both are not property dealers, individuals. For Ajay, it is a business income. For Mukesh, it is a capital gain that we'll have to compute. Discuss the tax consequences of the above in the hands of Ajay, Mukesh. Also compute the capital gain in the hands of Mukesh. And they've given information that none of the parties, that is Ajay, Mukesh, and Deepti, are related to each other. The transactions are between outsiders. So we'll have to see different provisions here. Section 43 CA will come into picture here. Section 43 CA in the hands of Ajay. And section 50C will come into picture in case of Mukesh. And 56 to 10. And section 56 to 10. In the hands of Divya or Deepti. Okay. So let us quickly understand. The provision says that on which date the stamp duty value authority should be considered. Now, whether I should take the stamp duty value as on the 6th April or 12th September. 6th April, it was 59 lakhs, and 12th September, it was 63 lakhs. Which stamp duty value I should take? If any amount is paid in advance in account pay check on the date of agreement, then consider the stamp duty value as on the date of agreement. So here, in this case, you need to take 59 lakhs. So 59 lakhs when you take, $59 lakhs is the stamp duty value. What is the actual transaction value, actual consideration? 55 lakhs. So 10% variation is allowed. So 110% of actual sale consideration. What is 110% of actual sale consideration? 55 lakhs into 110% is 60.5. So if the stamp duty value is more than 60.5, then you will consider the stamp duty value as the assessable value. Now, in this case, since the stamp duty value is less than 110% of actual consideration, actual sale consideration will be considered as the business income. So for Ajay, business income will be 55 lakhs. For Ajay, business income will be 55 lakhs. For Mukesh, no implication under section 56 to 10 because he has not received any benefit because it is within the allowed limit of 110%. But in terms of sale, he has made sale for 65 lakhs. And what will be his cost? His cost will be 55 lakhs, what he paid. And there will be a short-term capital gain of 10 lakhs in the hands of Mukesh because he is sold within 1 year. So the period of holding should be 24 months in order to get the benefit of long-term capital gain. In case of property, since it is less than 24 months, it will be taxed at short-term capital gain of 10 lakhs. Now, in the hands of Deepti, is there any implication? In the hands of Deepti, there is no implication. Again, the 65 lakhs is the transaction value, and the stamp duty value is 64 lakhs. Since the difference is less than 10%, and since it is on a higher value, Mukesh is paying tax on the higher value. So the tax authorities have nothing to say. If you read this entire thing, you have this all explanation given here. So there is no implication in the hands of Mukesh and Ajay. So that is the answer that you need to write. So for 5 marks, they have asked many things to be answered here. So it is slightly a higher technical related question. Moving to the last sub question of question number 4A, they've asked differences between capital receipt and revenue receipt. You need to give reasons. 5 transactions are given for you to categorize under capital receipt and revenue receipt. An amount of rupees 1,60,000 was spent by a company for spending its production manager abroad to study. So this is a revenue expenditure. So thereby it has to be capitalized. It need not be capitalized, and it is related to business and it is revenue expenditure. Now, because of this expenditure, the company's ability to perform well is increased because manager will go and learn and come something, and he will be able to do better performance in his business. In order directly, it is helping the business growth. So it is a revenue expenditure. B and Co received 4 lakh as compensation from C and Co for premature termination of contract. Any compensation received is a capital receipt and it is considered as capital in nature. Payment of rupees 60,000 as compensation for cancellation. Again, capital receipt. You need to categorize as capital receipt and give the reasoning. Our company limited, instead of receiving royalty year by year, received it in advance. Whether you receive royalty in advance or in lump sum or month on month, it is revenue receipt and it is revenue in nature. An employee director of a company was paid rupees 3,60,000 as lump sum consideration for not resigning from directorship. Anything in lieu of salary is given. So it is an amount given in lieu of salary. This will be considered as revenue in nature. So transaction B and C are capital in nature. A, D, and E are revenue in nature. Okay. And all of them are expenditure here. D and E, A, B, C is expenditure. D and E is revenue here, income. So this is the overall part of discussion of part 1 of income tax. So let me quickly have a look at the chat. If any questions are there, we will look into it in terms of the question number 1 to 4 on direct tax. So we will pause here for a minute, and if there are any questions, quickly answer, and I will be back in a minute. And if there are no questions, then we'll proceed further to part B, question number 5 and question number 6, 2 alternatives on indirect tax, that is GST and custom law. Okay, so let's continue with part 2 or part B of the GST provisions and customs law. Now again, question number 5 is a comprehensive question split into 2 parts or 3 parts. Look into it. Question number 5, if you quickly go to the end, what are they asking? There are 4 sub questions that they are asking for 20 marks. Okay, what will be the effective date of registration? And also, is there any requirement to issue revised invoice? So they're asking about registration. With reference to transaction with Vikram Limited, determine the time of supply. So only time of supply needs to be checked. Decide whether in respect of goods supplied to Vikram Limited, MNO and Co needs to mandatory generate e-way bill or not. Assume this is the case of intrastate and rate of tax on taxable goods to be CGST and SGST at 9%. So this is on e-way bill provision. You're required to determine the export duty payable under custom law. So customs also is come into picture. So 5 marks each, 4 different questions, 20 marks for first question. And the next question, another question will have 20 marks. So thereby, how do you look at it? The question, the first question here is MN and Co a partnership firm is engaged in manufacturing of equipment in state of Gujarat. The firm became liable for registration under GST on 14th July 2022. It applied for registration on 14th August 2022 and was generated the registration certificate or granted the registration certificate by department on 18th August 2022. The registration provisions very clearly state that the moment somebody becomes liable for registration, they need to apply for registration within 30 days from the date becoming liable to register. If they become liable for registration and from that date within 30 days, if they make the application, the effective date of registration will be the date of liable for registration. If somebody misses to make the application within 30 days, then the effective date of registration will become the date of grant of registration. In the given scenario, 14th July 2022, 14th July 2022, and 30 days from here is 13th August 2022. But the application was made on 14th August 2022. Since the application was made outside the 30 days period, the effective date of registration shall be 18th August 2022. So from 18th August 22, you are required to issue GST invoices. Hence, there won't be any revision requirement. So there is no requirement to revise the GST invoices or revision of any invoices. So there it solves your first question. If you see here, very clearly they say that the 40 lakh, 20 lakh revision, 30 days you need to make an application. In view of the aforesaid provision, effective date for registration shall be 18th August since company applied after 30 days of becoming eligible. And ideally, the provision given is if the date of registration is retrospective, if the date of registration is retrospective, then the invoices issued from the date becoming liable till the date the grant of registration, the invoices should be revised within 1 month from the date of issuance of GST registration certificate. But in this case, since there is no retrospective registration given, there is no requirement for revision of any invoice. So that is your question number 1. MN Co. supplied goods to Vikram Limited. The terms of contract stipulated the goods are delivered to factory of Vikram Limited. Goods were removed from factory of MNO and Co. on 9th November 2022 and were delivered to the factory of Vikram Limited on November 15th. So there are 4-5 dates here. November 9th it removed. It was delivered on November 15th. Invoice was issued on November 18th. And the payment credited on December 20th, but entry was made on November 19th. So what is the time of supply? The time of supply is the date of receipt of money or the date when the entity become liable to raise the invoice. What is the date of becoming liable to raise the invoice? Within 30 days from the date of service, in case of service. In case of goods, at the time of movement of goods, removal of goods from the factory. So from November 9th is the last date to raise the invoice because you're moving the goods outside the factory premises on November 9th. November 9th or the actual date of invoice that you have raised in November 18th. So in this both the case, the time of supply is November 9th. So November 9th will become the time of supply. So it is clearly analyzed here. So November 9th, actual date of issue of invoice is November 18th. Due date to raise invoice is November 9th. So date of receipt of payment is November 19th, whichever is earlier. So therefore, the time of supply would be the earliest of the above dates, that is November 9th. So your time of supply provision, you need to explain in terms of how and what and accordingly give the reasoning. Then comes the next question in terms of the e-way bill. E-way bill is required to be generated if the value of supply is more than 50,000. What all supplies should be considered? Apart from exempted goods, everything else needs to be considered, including the tax and the job work related any supply. Now in this, 28,000 is taxable supply, 13,000 is exempt supply. So you should ignore 13,000. And job worker, whatever job work you are sending, that also needs to be included. But tax on job work is not required. So 28,000 they have given. All amounts are excluding GST. In the question, they have given that you need to consider GST at 9% each. So 18% GST. So if we take 28,000 is the taxable supply on this 18% GST. So the total value will become 28,000 plus 5,000, 33,000. Exempt supply 13,000 is not considered for the purpose of evaluating the e-way bill, and 16,000 that is given in terms of the job work. There is no tax that you need to consider. You need to consider only 16,000. So the total here is 49,040, which is less than 50,000. Thereby, there is no requirement for generation of e-way bill. First, you need to write the provisions of e-way bill. E-way bill is mandatory to be generated whenever there is movement of goods of consignment value exceeding 50,000. Consignment value of goods shall be the value includes the value declared in an invoice, a bill value, a delivery challan, everything. Delivery challan is given for job work, and it excludes the exempt goods. So accordingly, we have computed, and since the consignment value is not more than 50,000, e-way bill is not required to be generated. That is your question number 5, part 3. What is question number 5, part 4? It is on calculation of customs thing. Here you need to remember what rate has to be considered for conversion. That is on the date of the submission of the presentation of shipping bill. So shipping bill date has to be considered, and the exchange rate should be considered on the date on which the export is confirmed. That is let export order. That is 29 November 2022, 10%. So in the question that they've given $60,000 converted at the rate of 78 rupees and calculated export duty at 10%. So let's take shipping bill date is 17th October and let export order date is 29th November. So on this date, exchange rate was 78, and on this date, exchange rate was 77. And on this date, exchange rate was 12%. On this date, export rate duty was 10%. So for the purpose of exchange rate, you need to take the shipping bill date. And for the purpose of let order export date, you need to consider 29 November, 10%. So what is the value? $60,000. So $60,000 converted at 78 rupees, that will become 46,80,000. For 46,80,000, you need to calculate export duty at 10%. So this will become 4,68,000 export duty payable. Okay. In the guideline answer that they have given, the social welfare surcharge is not payable. If you see the note given, they specifically given export duty does not carry social welfare surcharge. But practically, social welfare surcharge is deemed. So 10% you need to add for that, but they have not considered that. So it is very simple. So they've given small questions and very simple questions, GST. The moment you know the provisions, it is very simple for you to look into it. So they're going minute. In case of custom law, it is very simple question that they've asked. But in terms of e-way bill, minutely they've asked. In terms of time of supply, minutely they've asked. The moment you know the question or the provision, then only you'll be able to answer. So thereby we move to the question number 6 and the last question, 6 or 6A. 6 or 6A, again you have 4 sub questions, 5 marks each of the alternative. Either you can answer, you cannot pick and choose. I will write 2 sub questions of 6 and 2 sub questions of 6A. So you will not get full marks. So you will get marks only for 1 question. So you need to answer 6 completely or 6A completely. Rama Private Limited, Mumbai, a registered supplier, manufactures taxable goods. It provides the following details of taxable interstate supply made by it during the month of March. So list price of taxable goods, 20 lakhs. Subsidy received from central government. Subsidy received from central government is not considered for taxation. So you will ignore it. You need not add it, it will not come into the value of supply. So this question is on a value of supply. And taxes paid to the municipal authority should be added. Special packing request should be added. And late fee paid is 7,080. This is including of GST. So you need to bring it down and then add it. So let's quickly look into this. So if you see, the first thing is 20 lakh that they've considered here. So 3,50,000 is nil. You should not consider. If it is received from anybody else apart from central government, then you need to add. But if it is received from central government or state government, you need not add into the taxable value. Taxes levied by municipal authority considered. Packing charges considered. Late fees 7,000 is there. You need to back work and get the taxable value 6,000. So all of this, once you add, you get the taxable value of 20,41,000. For this, they've given a discount offered at 3% on the list price. Don't forget that it is the list price. What is the list price? List price is 20 lakhs and not 20,40,000. So 3% should be calculated on 20 lakhs. That is 60,000. 60,000. So 20,41,000 minus 60,000. Total value of taxable supplies become 19,81,000. So this is very important. Very simple question, value of supply. Two things that you need to keep in mind here is this provision of 3,50,000 in discount. Most of the students will forget. They will apply 3% on 20,41,000. So that will become very important and then you go wrong. So moving to the question number B. Yash started the business of supplying shoes in the state of Karnataka. From 1st April 2022, he makes only intrastate supplies. His turnover for April to June quarter was 20 lakhs and for July to September quarter was 110 lakh. So this is a composition scheme that they're asking how and when you can ask. So composition scheme says that you need to pay 1% if you're a manufacturer on entire value. And if you are a trader, you need to pay 1% on the taxable supplies. Okay, so that is the important key thing that you need to remember here. You are required to compute tax payable by Yash under composition scheme, assuming that he is a manufacturer. Will your answer be different if Yash is a trader? And they say out of 110 lakh, 1/4 of the total turnover is taxable and 3/4 or 1/4 of the total turnover in each of the quarter was exempt and 3/4 is taxable. So thereby you need to calculate accordingly. So, and you know that composition is applicable up to 1.5 crore, that is 150 lakhs. Since it is 110 lakh, it is possible. In the first quarter, no registration. He becomes liable only on 1st July because his turnover is more than 1,10,000. So Yash got himself registered under composition scheme with effect from 1st July. So 110 lakhs, if he is a manufacturer, 1% on 110 lakhs will be paid. Entire thing, whether it is taxable or exempt, entire thing will be paid. 1,10,000, 55,000 CGST and 55,000 SGST. If he is a trader, he need to pay 1% on taxable turnover. 110 lakhs, 75% is taxable. So 1% into 110 into 75%, 0.825 lakhs. That is divided by 2, 41,250 of CGST and 41,250 of SGST. That is nothing but 0.5% is the CGST and 0.5% is the SGST. So this is very clear. So this, if you don't know the difference, then you will either calculate 1% for taxable turnover in both the case, or you will calculate 1% for entire turnover in both the case. So that is what you need to remember in this question. Moving on to the next question in terms of input credit that you can claim. Sham Limited, a registered person, is engaged in the business of spices. It provides following details in relation to GST paid on inward supplies procured by it during the month of March 2023. So here very clearly they say different scenarios. Raw materials purchased, which is used for the purpose of sale to customer. On that input credit is 80,000. Eligible to be claimed, it can be claimed. Raw material purchased for personal use of director. So it says that if it is used for personal purposes, no input credit is allowed. So 20,000 input credit is not allowed. Second scenario, electric machinery purchased for being used in manufacturing process, complete input credit is allowed, provided you don't claim or you don't capitalize 35,000. So the section 16 says that in case of capital item, if it is not capitalized, you can claim the input tax credit. That means if you do not claim the depreciation benefit on the GST component, you are eligible to claim the input tax credit. So you can claim 35,000. Motor vehicle used for transportation of employee, anything seating capacity of 13 or less than 13, you are not eligible to claim the input tax credit on motor vehicle. So 55,000 not eligible. Payment made to contractor for construction of a staff quarter. So anything paid for the benefit of staff in terms of construction, not allowed. 2 lakhs, not eligible. So this is the overall solution that you have. 80,000 for sales, onward sale, eligible. Personal use of director, not eligible, nil. 35,000 eligible if it is not capitalized. Motor vehicle, if it is less than or equal to 13, nil. And in case of construction, 17.5 says that specific thing in terms of immovable property, and that too for the purpose of staff, it is nil. So eligible is 80,000 and 35,000. Total is 1,15,000. Very clearly, they're covering most of the types of transactions, and students, you should be very clear in terms of what you are learning and be specific to the question and answer with clarity conceptually what they're asking. That is the more important focus that you need to take. So question number 6, part C, is all about input tax credit that we have discussed. Next, they have given the calculate FOB value, cost of insurance, cost of freight, and assessable value under custom law, where only CIF value is given as $8,000. Exchange rate notified by RBI and CBIC are 78 and 79 respectively for $1. So here, see, now you see customs that they've given 2 questions of 5 marks. So 10 marks from customs is very clear, and everything is coming from valuation. So this time, last time they've asked 2 valuation questions. This time they can ask some procedural, theoretical question also. So be very focused about the theoretical question that can come from the customs in terms of warehouse, baggage, or in terms of the rules of valuation, or in terms of the basis of valuation, or in terms of the classification, HSN code, or in terms of the how the values needs to be considered. All of this is going to come in terms of the theoretical question. Now let's calculate the FOB value. Let's directly go here. Custom valuation says that freight has to be taken 20% of FOB value and insurance has to be taken 1.125% of FOB value. And CBIC rate notification of 79 should be taken. Hence, FOB value, cost of insurance, and cost of freight and assessable value shall be computed as value as per this. Assessable value will be CIF value, that is cost including freight. So 8,000 into 79, 6,38,000 is coming as the CIF value. Less cost of insurance. Cost of insurance. Now here is the mathematical part that is included. Okay. Here it is the mathematical part that is included. How you will calculate here is in terms of what we say, FOB value 100, add freight 20%, that will become 20. Add insurance 1.125% on FOB. So 20% of 100 is equal to 20, and 1.125% of 100 is 1.125. So the total is 121.125. So this is CIF value. So in our example, they've given this CIF value. How they've given? CIF value is 6,32,000. We have arrived. 6,32,000. How did we arrive? 8,000 into 79. Now we need to calculate what is freight, what is insurance, and FOB value. How do we calculate? Backward calculation. If 6,32,000 is 121.125. 125.125. What is 1.125? You will get 5,870. That is what is given here. 5,870. Okay. And if 6,32,000 is 121.125, what is 20? That is 1,04,000. Now, if you subtract these two from this, you get the FOB value. Now, that is 5,21,775. Now, you do a reverse calculation. Let's start from, this is the FOB value given. 20% of FOB value, 1,04,355. 1.125%, 5,870. Now, if you add this, again, you will get back to the CIF value of 6,32,000. So here, little of math that you need to know, then you will be in a better position to solve this. Little of math you need to know. Understand this mechanism. If 6,32,000 is 121.125 is 632. What is 125? 1.125. Cross multiplication will give you the answer. If 6,32,000 is 121.125, what is 20? That will give you the FOB value or freight value. If 6,32,000 is 121.125, then what is FOB value? That is 100%. Now, if you add all, you will get 100 plus 20 plus 121. That is what we have taken, 121.125. That is, we are equating to 6,32,000. Very important, very calculation part. If you are not sure, practice it, solve in different way and get the comfort on this aspect. So that is all about your question number 6. Part A. Okay. Now let us proceed to part B. Now this is the question here that we have. 6A, 1A and 1B. Two questions are there. Okay. One is 3 marks and one is 2 marks. Okay. So what is the 3-mark question? So what are they asking? Piyush is a supplier taxable in Karnataka. He got registered GST in the month of April 2023 and wishes to pay his IGST liability for the month. Since he is making GST payment for the first time, he is of the view that he needs to mandatorily have the online banking facility to make the payment of GST. Offline payment is not permitted under GST or required to advise him with regard to the following issues. Are manual challans allowed under GST? No, it is not allowed under GST. Direct online payment is mandatory. What is the validity period of the payment challan? 15 days is the validity period of the payment challan. Is cross-utilization among major and minor heads of the electronic cash ledger permitted? Yes, it is permitted. The CGST cash ledger can be utilized against the CGST liability and IGST liability of the different cash ledger, major and minor heads, that is permitted. So if you see the answer, manual or physical challans are not allowed. Payment challan is valid for 15 days. A registered person may on the common portal transfer an amount of tax, interest and penalty fee or any other amount available in electronic cash ledger of CGST to electronic cash ledger of IGST or CGST or SGST or Union Tax Territory. So it can be transferred. So cross utilization is allowed. Moving to the question number B, what will be the late fee of CGST or SGST for delay in filing of annual return? So if you see here, it is all procedural aspect. For financial year 22-23, if delay is for 47 days and turnover of the company was 5.2 crore. So clearly for annual return, the late fee is 0.4%, okay, or 0.4% of the turnover if turnover is more than 5 crore or 200 rupees per day. So if you see here, 0.04% of the turnover or 100 rupees per day, whichever is lower. So 100 rupees per day is 4,700. 0.4% of 5.2 crore is 20,800, whichever is lower, 4,700. This is given as per notification 7/2023, ending 31st March 2023. Now, This is a notification that has come on July 2023. So this was relevant in the previous examination. So now you'll have to look at if there is any notification that are issued during 23-24, which will become applicable for you. So this question, this notification might not come. This question might not come. But this is on an amendment perspective. So quickly go through all the amendments and expect a question on 5 marks from the amendments. That is the objective, to understand and dissect the question paper. The next sub question, a government department is registered under GST. Its aggregate turnover in the preceding financial year was 22 crore. You are required to comment with the help of relevant provision whether the said department is required to issue e-invoices in the current financial year or not. Ideally, e-invoicing provisions is applicable. It was introduced in a graded manner. First, it was applicable for turnover for more than 500 crore. Then they reduced to 250 crore, then 100 crore, then 50 crore, then 25 crore, then 5 crore, and 20 crore. So they've reduced all of this turnover. So it is liable. But they've given certain exceptions. Government department and certain other people are not required to, or the e-invoice provisions are not applicable. Who are those? So here they say NBFC, Special Economic Zone units, NBFC, GTA, suppliers of passenger transportation services, person supplying services by way of admission to the exhibition of cinematic films, government department and local authority not required to issue e-invoice. They have been relaxed. So, but they'll have to mention in their invoice that they are exempt and the turnover is crossed the invoicing provisions, but they have a exemption or a relaxation for not issuing the e-invoicing. So declaration is required. So that is what you need to write, because you are required to comment with the help of relevant provisions. They are required to do or not. So this is the 5-mark question that they've asked on the e-invoicing again. The third sub question here is on the provisions of the recovery assessment provisions. ABT Limited has business place in 4 states of India and accordingly registered with GST authorities in each state. One of its branch located in Karnataka defaulted for payment of tax for the month of March 2023. Upon conclusion of adjudicating proceedings, the authorities believe that they can proceed for recovery under Section 79 against any registration of the ABT Limited. See, the tax was not paid in Karnataka, but they had registration in 4 different states. Can the GST authorities has power to recover from any state? Yes, they have any state. What else they have power? They can realize from any asset that is there in any of the state. And anybody who is required to pay to the ABT Limited, they can stop paying them and they can recover that money. So there are 5 to 6 things that are given which need to be remembered. What are those? Various methods available for recovery of tax areas, deduction out of money owing to the defaulter. By DTA, they can stop the selling of the goods and they can collect the recovery from the products, recovery from other person who owes the money to the defaulter, collection by detention of any movable or immovable property, recovery through district collector, recovery through magistrate. So these are all the things. The department view is correct. They can recover from any registration of the same PAN of the same entity through these methodologies. So this is your third sub question of alternative question number 6A. The last question is on the place of supply and location of supply. G Mega Events, an event management company registered under CGST Act 2017 at Mumbai, organizes a marriage function for Rakesh of Hubli. Determine the place of supply in the following independent cases. If Rakesh is registered at Hubli, Karnataka, and function held at London. So in case of a registered person, the place of supply shall be the place of registered wherever he is registered. If the location of supply is outside India, since it is held outside India, the place of supply shall become Hubli and Karnataka. The second situation says that the function is held at Delhi, but it is registered and given in Hubli. So here it does not matter. Again, the place of supply shall be Karnataka, and here it will become the place where the function held, but it will become New Delhi. If you see the reasoning here, this is how you need to write. For supplies related to organization of events, when such services provided to a registered person, the place of supply shall be the location of recipient. Since recipient is registered at Hubli, the place of supply shall be Karnataka. Here also, the place where If the recipient is registered, the place of location of the recipient is the place of supply. So the place of supply shall be Hubli. Here, the event held in Delhi is not relevant. Now, in the third situation, if Rakesh is unregistered person, if the Rakesh is unregistered person and the function is held at Delhi, since the person is not registered, then I'll have to go where the service is held, service is done. Since the service or the event is organized in Delhi, the place of supply shall become Delhi. When it is provided to an unregistered person, the place of supply is location where the event is held, because the person of the recipient of the service is not registered. So I'll have to go where the place of service. The recipient being an unregistered person, the place of supply is location where the event is held. And the last thing, if Rakesh is unregistered person and function is held at London, can I tell the place of supply is London outside India? I don't have jurisdiction. The person is unregistered. So then I will take where the person of supplier is registered. When it is provided to an unregistered person and if event is held outside India, the place of supply is the location of the recipient. Where is the location of the recipient? Who is taking the, Rakesh is taking the service. Rakesh is situated in Hubli. The marriage function of Rakesh organizes a marriage function for Rakesh of Hubli. Rakesh is of Hubli, then you will take the Hubli as the Karnataka as the state of the place of supply. The recipient being an unregistered person and the event held outside India, the place of supply is the location of the recipient, that is Hubli, and not the location where the event is held. So this is the overall aspects of the place of supply. So this is the kind of question that you can get. Now, if you see sum and substance in the last 5 minutes, let me see, I've completed the evaluation of discussion of each and every question. But few points for us to discuss before we end the live session for discussion of tax law question paper is that very important. So by the time, if there are any questions, you can put it on the chat box. Just now I see that there are no other questions for me to answer on the chat box. But if there are anything as we discussed for the last 5-10 minutes, you can put it in the chat box. Question paper is very vast. And the provisions are being asked from nook and corner of every chapter. Specifications are important. Exclusions are important. What is excluded is what is asked. Example, the e-invoicing provision is not applicable for government company. Exclusion is being asked. The trader of composition and the manufacturer, to variation where it is critical, not straightforward. Little important is what is observation is required. So those are the kinds of things that you need to focus. Read the end part of the question and relate the concept with the fact and then answer. Ensure what you are answering is in specific to the concept clarity given. And ensure that you don't get stressed with the length of the question, but ensure that you read the sub-segment, answer each segment by segment, and get your answer right. Present it in a tabular format. Write what you're answering. Give the conclusion for what the answer that you have derived, and present your answer in a well manner. That is very important. With that, I would like to end the live session. I see there are no questions at any point in time. If there is any questions, you can reach out to us through our Ekcel Academy WhatsApp number, and we can be of assistance to your challenges or clarifications required. With that, wishing you all the best for your exams, and look forward to meet you again in another session in future. Thank you all, and we'll end the session here.